If you own a short-term rental, I'm about to show you a completely legal tax strategy that could let you use your rental losses to wipe out income from your day job. Most people don't know this exists, but the IRS has special rules for short-term rentals that can save you thousands of dollars. This isn't some sketchy loophole. It's actually written in the tax code. So I'll talk about some of these rules. The seven-day rule. Here's the key. If your guests typically stay 7 days or less, your property isn't automatically treated as a passive rental, like regular rentals. This opens the door to something tax professionals call a short-term rental loophole. Here's how you calculate it. Take your total rental days and divide by the number of bookings. So if you have 20 different guests who stay 100 days, your average stay is 5 days. You qualify since it's less than 7. But meeting the 7-day rule is only half of the battle. You also need to prove you materially participated in your rental, and this is where most people mess up. So what is material participation test? The IRS gives two main ways to prove you materially participated. The first one is a 500-hour test. So this one is a high bar, spending more than 500 hours per year on your rental activities, guest communications, cleaning, maintenance, marketing, bookkeeping, and you're automatically in. This includes your spouse's time too, even if you don't own the property. The second material participation test is a 100-hour test. Spend more than 100 hours and make sure no one else, including contractors, work more than that many hours. So if your cleaning service puts in 150 hours, but you only do 120, you fail the test. This is absolutely key is to have documentation. You must track your time as you go, calendar, spreadsheet, whatever works. Don't try to recreate this later. So another one is the Augusta rule. So this is completely different strategy but it can be used very effectively. So you rent your personal home for 14 days or less and you pay zero tax on the income. Business owners, you can use this to rent out your home to your own company for board meetings, strategic planning. Your business deducts the expenses, you pocket the income tax free. Just charge fair market rent. Okay, so that's another one. So, but here's where you absolutely cannot mess up. You just have to provide a lot of documentation and understand what schedule you'd be on the tax return. So poor record keeping is no excuse. For example, Schedule E for basic rental services. Okay, that's where you typically see rentals. Schedule C if you're providing substantial services like daily housekeeping or concierge work. Get this wrong and you either miss out on the benefits or pay unnecessary self-employment taxes. These strategies can save you thousands, but the rules are complex and the stakes are high. One big mistake can cost you years of benefit. I haven't covered all the details of this blog post. You can link to it in the description, but you want to see if you want to see if your short-term rentals qualify for these tax benefits. You can always schedule an initial consultation or drop me a comment. I'd love to hear your experience. Have a good day.